So today we're talking about a topic that is crucial for every real estate owner, investor, anybody to understand, and that is property taxes. We want to understand the property tax process, how it works, how it's assessed, and ultimately how it can change along the way. So let's hop right in. So the first piece of the puzzle is going to be to understand your assessed value. The assessed value is the value that the tax assessor's office gives to your property for tax purposes. Now, this is not what your house is actually worth on the open market. This is just for tax purposes. The way they come up with the assessed value is whatever you paid for the property, right? So if I just bought a property today for $1 million, my assessed value is going to be $1 million. However, in California, we have some laws that only allow property taxes to go up a certain amount. There's a cap on how much the taxes can go up. So if my property value goes up 10%, my property might be worth 1.1 million in this example, but the property tax assessed value is only allowed to go up, I believe, a maximum of 2% a year, in which case my assessed value would be $1,020,000. It's important to know what your assessed value is because they're going to take the value and then apply a tax rate to that assessed value, and the way they come up with the assessed value is the purchase price of the property upon transfer and then up to a 2% increase in any given year. Now that we have an understanding of what our assessed value is, now we want to understand our tax rate. So in the county of San Diego, there are, I believe, 14 different jurisdictions, and each of them have a different tax rate ranging from about 1.1% to about 1.25%. You're probably going to fall somewhere in that range for your tax rate. 14 jurisdictions, what I mean by that is you have the county of San Diego and the unincorporated areas, and then each city is going to have their own tax rate. You know, Oceanside, Chula Vista, La Mesa, Escondido, El Cajon, and on and on and on. So now within each jurisdiction, there's going to be that base tax rate, which I just described, and then on top of that, there's going to be what they call fixed charges and assessments. And this is additional taxes above and beyond the base rate that covers things like vector and like mosquito control, like some water charges, Melrose taxes could be included in there, etc. For example, like a city like Chula Vista might have a base rate of, and I will pop the base rate for Chula Vista on the screen, but let's say the base rate is 1.15 in Chula Vista. Well, if I live in Eastlake and you live in Rolling Hills Ranch, those are both neighborhoods in Chula Vista. I might have Melrose where in Rolling Hills Ranch they don't. So same city, same base tax rate, but I have higher property taxes. So there's the assessed value, your base tax rate, and then the fixed charges and assessment on top of that. This is how you get, the overall scope of what your total tax bill is going to be. Step 3 is to know your exemptions. Your assessed value in our prior example was $1 million. There are some exemptions such as homestead exemptions, veteran exemptions, senior exemptions, things of this nature that allow you to lower the assessed values. If my property value is $1 million and I have an exemption for, the exemptions aren't that much. If the exemption is for, say, $10,000, it basically lowers your assessed value and lowers your taxes some. And again, if you're watching this and getting super excited, like, oh, I can save some money on my taxes, you probably can, but it's generally not that much. Like, I think the homestead exemption right now is something like $7,000. So if you have an assessed value of $700,000, $800,000, $900,000, yeah, you might get $7,000 off the assessed value. Going to not mean very much money dollar-wise, but penny saved is a penny earned. So make sure you understand your exemptions and know how to lower your property taxes as much as possible. Step 4 in the property tax process is to review and understand your bill. This gets billed twice a year, so every 6 months you're paying property taxes. And if you have a mortgage on your house and it's set up with impound accounts, meaning you pay your property taxes as part of the mortgage payment process, you still want to make sure that you're checking on your bill every 6 months about the time it's due to make sure of a couple things. One, that you're not being billed for more than you should be, and two, that your mortgage lender is actually making the payment, because even though the mortgage lender is supposed to pay it, if they don't get it there on time, if anything happens, it's still your responsibility. Late fees and delinquencies will be your responsibility even if the mortgage lender doesn't send the money. So make sure you're reviewing your property tax bill and make sure it's getting paid by your mortgage lender if you're set up that way. Another thing that you're going to want to look at in the bill is make sure that it's accurate, because I can't tell you how many times we've walked with clients through tax bills or even my own tax bills personally, and they are incorrect for some reason. When you are moving your property into a trust or out of a trust or doing refinance or adding a new spouse to title or taking a divorced spouse off a title, when you are making these changes, a lot of these changes should not trigger new assessments. In some cases they do, depending on what it is you're up to, but a lot of these things like taking your home that you own and moving it into a trust, that shouldn't trigger a new assessment. But if you do the paperwork wrong, or if they file it incorrectly down at the county assessor's office, you might find that they increase your assessed value and start charging you for more taxes that you shouldn't be owing. So make sure to check on it periodically and make sure that your assessed value is correct. If you've done any of these movements with title, meaning putting it in and out of a trust, refinancing, divorcing, things of that nature, make sure that you're not being triggered for a new assessment where you shouldn't be. So again, review the bill, make sure it's accurate, and make sure you're not getting charged more than you should be. So step 5, the last thing that you want to consider when you're considering property taxes is if your assessed value is too high for the value of the property today, you can appeal it. You can go to the tax collector and say, hey, I think you're assessing my property value too high, I'm paying too much in taxes, and they will do a review and an assessment and see if they do indeed need to bring your property values down. In the crash around 2008, 2009, 2010, when property values significantly decreased to the tune of 20, 30, 40%, there were a lot of people who went to the tax collector and said, hey, my property is no longer worth what you are assessing me for. I want to appeal it, review it, and there have been people who have had success bringing their assessed value down, thus saving them money on a monthly basis for property taxes. So make sure that your assessment is roughly in line with the actual value of the home. So there you have it. Those are 5 things that you can think about when it comes to your property taxes. So whether you're an owner-occupier or a seasoned investor that you own multiple properties, it's important to make sure that we're not paying more taxes than we need to be, so we can maximize our returns if it's a rental, or maximize our savings if you're an owner paying for property taxes, because it just really doesn't make any sense to give the government more money than they are entitled to.